Welcome to the world of the stock market. Whether you're looking to invest for your future, save for retirement, or simply grow your wealth, understanding the basics of the stock market is essential. In this beginner's guide, we'll cover everything you need to know to get started on your investment journey. But before we go further, please remember to subscribe and turn on notifications so you keep getting self-development tips like this. Now, let's get right to it. Here are 7 important things you should know that will help you to invest profitably in the stock market. 1. Understand what the stock market is. The stock market is a dynamic and multifaceted financial ecosystem where investors buy and sell shares of publicly traded companies. At its core, the stock market serves as a platform for businesses to raise capital by offering ownership stakes in the form of stocks or shares to investors. These shares represent a proportional ownership interest in the company, entitling shareholders to a portion of its profits and assets. Investors participate in the stock market with the goal of generating returns on their investments through capital appreciation and dividends. Companies sell shares of their ownership to the public through an initial public offering, IPO, and these shares are then traded on stock exchanges like the New York Stock Exchange, NYSE, or NASDAQ. Furthermore, the stock market functions as a barometer of economic health, reflecting the collective sentiments and expectations of investors about the future performance of businesses and the broader economy. It provides liquidity, allowing investors to buy and sell securities with relative ease. The stock market is comprised of various exchanges and trading platforms, where stocks are bought and sold either electronically or through traditional trading floors. Additionally, it is heavily influenced by a myriad of factors including economic indicators, geopolitical events, corporate earnings reports, and investor psychology, making it inherently volatile and subject to fluctuations in prices. 2. Why you should invest in stocks. Investing in stocks offers a myriad of compelling reasons that make it a cornerstone of wealth-building strategies. Firstly, stocks have historically outpaced many other investment options in terms of long-term returns. Despite short-term fluctuations, the stock market has demonstrated remarkable resilience and upward trajectory over time. By investing in a diversified portfolio of stocks, investors can benefit from the growth potential of various industries and companies, thereby spreading risk and enhancing potential returns. Additionally, stocks provide an opportunity to participate in the success of leading companies and innovative ventures, allowing investors to align their financial interests with the broader economy's growth. Moreover, investing in stocks offers liquidity and flexibility, allowing investors to buy and sell shares relatively easily compared to other asset classes such as real estate or private equity. This liquidity ensures that investors can swiftly adjust their portfolios in response to changing market conditions or investment objectives. Furthermore, with the advent of online brokerage platforms and investment apps, stock investing has become more accessible than ever before, enabling individuals to start investing with small amounts of capital. Ultimately, investing in stocks not only offers the potential for substantial financial gains over the long term but also empowers individuals to take an active role in building their wealth and achieving their financial goals. 3. How the stock market works. The stock market functions as a vast marketplace where individuals and institutions trade shares of publicly listed companies. At its core, the stock market operates on the principles of supply and demand. When investors believe a company's prospects are favorable, they buy its stock, increasing demand and driving up its price. Conversely, if sentiment sours or negative news arises, investors may sell their shares, causing the price to fall. This constant interplay of buying and selling dictates the fluctuations in stock prices. Various factors influence investors' decisions, including company performance, economic indicators, geopolitical events, and investor sentiment. Additionally, stock markets provide liquidity, enabling investors to easily buy and sell shares, thus facilitating capital formation and allocation. Central to understanding the stock market is the concept of ownership represented by shares or stocks. When individuals purchase shares of a company, they acquire ownership stakes in that company proportional to the number of shares they hold. This ownership grants them certain rights, such as voting on corporate decisions and receiving dividends, which are distributions of the company's profits. The stock market operates through exchanges, where buyers and sellers come together to execute trades. These exchanges serve as platforms for trading securities and ensure transparency, fairness, and liquidity in the market. Furthermore, advancements in technology have transformed the landscape of stock trading, with electronic trading platforms facilitating rapid transactions and providing access to a global pool of investors. 4. Types of stocks. Stocks, often categorized based on their characteristics and underlying fundamentals, can be broadly classified into two main types: common stocks and preferred stocks. Common stocks represent ownership in a corporation and typically grant shareholders voting rights in company decisions, such as electing the board of directors. They offer the potential for capital appreciation and dividends, though dividends are not guaranteed and can vary based on the company's profitability. Common stocks are subject to market fluctuations and are considered riskier than preferred stocks. Conversely, preferred stocks represent a hybrid security that combines features of both stocks and bonds. Preferred stockholders receive fixed dividend payments before common shareholders and have a higher claim on company assets in the event of liquidation. However, preferred stockholders usually do not possess voting rights, and their dividends are typically fixed, making them more akin to fixed income securities. 5. Risks of investing in stocks. Investing in stocks offers the potential for significant returns, but it's not without its risks. One of the primary risks investors face is market volatility. Stock prices can fluctuate wildly in response to various factors such as economic indicators, geopolitical events, and company performance. These fluctuations can lead to sudden and substantial losses if investors aren't prepared to weather the storm. Additionally, the unpredictability of the market can make it challenging to accurately time buys and sells, further increasing the risk of financial loss. Another risk associated with investing in stocks is company-specific risk. Even the most well-established companies can face setbacks such as lawsuits, management scandals, or product failures, all of which can negatively impact their stock prices. Diversifying one's portfolio across different sectors and industries can help mitigate this risk, but it doesn't eliminate it entirely. Furthermore, investors must stay informed about the companies they invest in and continuously monitor their performance to identify any emerging risks that could affect their investment. Overall, while investing in stocks can be rewarding, it's essential for investors to understand and manage the associated risks effectively. 6. How to invest in stocks. Investing in stocks can be a rewarding endeavor, but it requires careful planning and strategic decision-making. The first step is to educate yourself about the stock market and how it operates. This includes understanding key concepts such as market trends, valuation methods, and risk management strategies. Take the time to research different investment strategies and determine which approach aligns best with your financial goals and risk tolerance. Additionally, familiarize yourself with the various types of stocks available, such as blue chip, growth, and value stocks, to diversify your portfolio effectively. Once you've acquired the necessary knowledge, the next step is to establish a budget and set clear investment objectives. Determine how much capital you're willing to invest in the stock market and create a diversified portfolio that spreads risk across different sectors and asset classes. Next, you should open a brokerage account by choosing a reputable brokerage platform that suits your needs and offers access to the stock market, and monitor your investments. Remember to regularly review and adjust your portfolio as needed to ensure it remains aligned with your financial objectives and risk tolerance. Finally, consider seeking guidance from financial advisors or utilizing online brokerage platforms to execute your investment strategies efficiently. 7. Emotions and discipline. Emotions play a significant role in stock investing, often influencing decision-making processes more than rational analysis. Fear and greed are two dominant emotions that can drive investors to make impulsive decisions, leading to buying at market peaks or selling during downturns. Discipline acts as a counterbalance to these emotional impulses, serving as a guiding principle for investors to stick to their investment strategy despite market fluctuations. It involves setting predetermined investment goals, risk tolerance levels, and exit strategies, and adhering to them regardless of short-term market movements. Emotionally disciplined investors understand the importance of maintaining a long-term perspective and are less likely to succumb to panic or euphoria, which can result in costly mistakes. Successful stock investing requires a delicate balance between managing emotions and maintaining discipline. Emotions such as fear of missing out can lead to chasing hot stocks without proper due diligence, while overconfidence can lead to excessive risk-taking. Moreover, discipline instills patience, helping investors to ride out market volatility and stay committed to their investment strategy over the long term. By cultivating emotional resilience and adhering to disciplined investing principles, investors can enhance their chances of achieving their financial goals and weathering the ups and downs of the stock market. Congratulations! You now have a basic understanding of the stock market and how to get started as an investor. Investing in the stock market can be both rewarding and challenging. Remember to start small, do your research, and stay disciplined in your approach to investing. With time, patience, and a long-term perspective, you can navigate the stock market with confidence. Happy investing! Toast to your success!